Michael Burry made $100 million by predicting the 2008 crash. But nobody talks about this. He also found 4 stocks that survived every crash since 1929. The Depression, Black Monday.com, 2008, COVID, all of them. I'm breaking down these 4 stocks and the pattern that connects them. If you're worried about protecting your money in the next crash, don't skip this. Hey everyone, welcome back to Smart Money Insights. And if you're new here, you're in the right place. We cut through the BS and focus on what actually protects and grows your money. Now look, before we get into these 4 stocks, I need to say this. I'm not your financial advisor. I'm not telling you what to buy. What I am showing you is how Michael Burry thinks, the same pattern recognition that made him millions while others lost everything. Here's what you're walking away with today. First, the 4 exact stocks Burry identified as crash-proof. Second, why these companies survived when 40,000 others went bankrupt. And third, this is the important part. The simple pattern you can use to find these kinds of stocks yourself. Because here's the truth. Knowing the stocks is nice, but understanding the why behind them, that's what actually protects your portfolio. All right, let's get into it. So who is Michael Burry and why should you care what stocks he owns? In 2005, when everyone thought housing prices only go up, Burry saw something different. He spent months reading mortgage documents, the boring stuff nobody else wanted to read. And he discovered that millions of home loans were garbage. So he bet against them. When the market crashed in 2008, Burry made over $100 million for his investors. But here's what most people miss. He didn't get lucky. He saw a pattern others ignored, and that's exactly what he does with stocks. While most investors chase what's hot, Burry studies what survives. He's not looking for the next Amazon or Tesla. He's looking for companies that will still be here when everything else collapses. His strategy is simple. Find businesses that people need, not want. Find companies with real cash flow, not promises. Find industries that existed 100 years ago and will exist 100 years from now. That's why his stock picks look boring to most people. No flashy tech startups, no crypto companies, just solid businesses that solve real problems. And here's the kicker. While everyone was panicking during COVID in 2020, Burry was buying, again. The same types of stocks he's been buying for decades. So when Burry keeps coming back to these 4 specific stocks, across multiple crashes across different decades, that's not random. That's a pattern. And that pattern is what I'm about to show you. Let's start with stock number 1. All right, stock number 1, and I'm going to warn you right now, this is going to sound boring. But that's exactly the point. The first stock is Johnson & Johnson. Yeah, the Band-Aid company, the baby powder company. And that's exactly why it's survived every crash since 1929. Let me explain what this company actually does. Johnson & Johnson has 3 main businesses. They make consumer products like Tylenol and Listerine. They make prescription drugs, and they make medical devices, things like knee replacements and surgical equipment. Now here's why this matters during a crash. When the Great Depression hit in 1929, people stopped buying cars. They stopped buying new clothes. They canceled vacations. But you know what they didn't stop buying? Medicine, bandages, basic healthcare products. Fast forward to 1987, Black Monday. The market dropped 22% in a single day. Worst crash in modern history. Johnson & Johnson stock, it recovered within months. Why? because hospitals still needed surgical equipment. Sick people still needed medicine. Then came the dot-com crash in 2000. Tech companies lost trillions. Pets.com went bankrupt. But Johnson & Johnson actually grew during that period, because while people stopped buying stupid internet stocks, they still got sick. They still needed health care. 2008 was the big test. The financial crisis. Banks collapsed. Car companies went bankrupt. Lehman Brothers disappeared overnight. And yes, Johnson & Johnson's stock dropped too. Everything dropped. But here's the difference. The company itself kept making money. Revenue actually increased. They kept paying dividends. And the stock recovered faster than almost anything else. COVID in 2020? Same story. While airlines and hotels were dying, Johnson & Johnson was literally making the vaccine. Their consumer health products flew off shelves. Medical devices were in massive demand. So what's the pattern here? Michael Burry calls this inelastic demand. That's fancy talk for people need this stuff no matter what. Recession or boom, people get sick. People need surgery. People use Band-Aids. But here's what makes Johnson & Johnson special compared to other healthcare companies. They're diversified across 3 different healthcare sectors. If prescription drug sales slow down, consumer products pick up the slack. If medical device sales drop, pharmaceuticals compensate. This is what Burry looks for. Not just a good company, a company with built-in protection. Now, the one metric you need to watch with Johnson & Johnson is their dividend history. They've increased their dividend for 62 consecutive years. That's not luck. That's a company printing cash in good times and bad times. Burry's position in Johnson & Johnson isn't huge, but he keeps coming back to it, quarter after quarter, year after year, because he knows that when the next crash comes, and it will come, people will still need health care. That's stock number 1. Boring? Yes, but it survived the Great Depression, BlackMonday.com, the financial crisis, and COVID. Now let's look at stock number 2, and this one operates in an industry that's even more essential. Stock number 2 is Procter & Gamble. And before you roll your eyes, yes, this is the soap and toothpaste company. But stick with me, because what makes this business crash-proof is genius. First, let me tell you what Procter & Gamble actually sells. We're talking Tide detergent, Crest toothpaste, Gillette razors, Pampers diapers, Charmin toilet paper. Stuff you use every single day without thinking about it. And that's the secret. During the Great Depression in the 1930s, when unemployment hit 25%, people stopped buying almost everything. Except they still brushed their teeth. They still washed their clothes. They still used soap. Procter & Gamble not only survived, they actually gained market share because smaller competitors went bankrupt. Let's jump to 1987. Black Monday hits. The market crashes 22% in one day. Panic everywhere. But Procter & Gamble? Their sales barely budged. Because even when people are scared about money, they're not going to stop buying toilet paper. The dot-com crash in 2000? While tech investors were losing everything, Procter & Gamble kept selling razors, kept selling diapers. The stock dropped some, sure, but the business kept printing money. 2008 was the real test, the financial crisis. People lost their homes, lost their jobs, had to cut spending everywhere. But here's what happened. They switched from eating out to cooking at home, needed more Tide for laundry. They still had babies, needed Pampers. They still needed to shower, used Procter and Gamble soap. COVID? Same exact thing. Panic buying. What did people hoard? Toilet paper, cleaning products, all Procter and Gamble brands. Now here's what Burry understands that most investors don't. Procter and Gamble has something called brand moat. You walk into any store in America, Walmart, Target, CVS, and Procter and Gamble owns the shelf space. They've spent 100 years building these brands. A new company can't just show up and replace Tide or Crest. It's nearly impossible. This is why their competitors struggle. Every few years, some startup tries to disrupt them with natural soap or eco-friendly detergent, and they get a tiny slice of the market. But Procter and Gamble still dominates because people trust what they know. The one warning sign to watch: if Procter and Gamble ever starts losing shelf space to store brands or new competitors, that's your signal. But in 100 years, it hasn't happened yet. Burry owns this stock because he knows that in the next recession, people will cut their Netflix subscription before they stop buying toothpaste. Survival isn't about being exciting. It's about being necessary. All right, that's stock number 2. Now let's get to number 3, and this is the one most people have never even heard of. Stock number 3 is going to surprise you because most people have never heard of this company. It's called Berkshire Hathaway. Wait, you might be thinking, that's Warren Buffett's company. What does that have to do with Michael Burry? Here's what most people don't understand. Berkshire Hathaway isn't just an investment company, it's actually a collection of boring essential businesses. They own insurance companies, railroads, utilities, and energy companies. The most unglamorous stuff you can imagine. And that's exactly why it survives crashes. Let's break down what happened in each major crash. During the 1987 crash, while tech and financial stocks were getting destroyed, Berkshire's insurance companies kept collecting premiums. Their utilities kept delivering electricity. Boring businesses that people need every single day. In 2000, during the dot-com crash, everyone was chasing internet stocks with zero revenue. Berkshire? They owned See's Candies, Geco Insurance, and furniture stores. Real businesses with real cash flow. While tech investors lost 80%, Berkshire barely dropped. 2008 was fascinating. The financial crisis crushed almost everything, but Berkshire had so much cash on hand that Warren Buffett actually became a lender of last resort. He bailed out Goldman Sachs and Bank of America and made billions doing it. That's the power of owning boring, cash-generating businesses. COVID in 2020? Same pattern. While airlines and retail were dying, Berkshire's utilities kept running. Their insurance companies kept operating. Their railroad kept moving freight. Now here's Burry's genius insight that others miss. He doesn't own Berkshire because of Warren Buffett's stock picking. He owns it because it's essentially a diversified collection of crash-proof businesses wrapped into one stock. Insurance, energy, railroads, utilities. These are industries that existed 100 years ago and will exist 100 years from now. The moat here is simple. These businesses require massive capital to start. You can't just launch a new railroad or utility company. The barriers to entry are huge. That means less competition and more stability. When does this become a sell? If Berkshire ever starts moving away from these boring essential businesses and chasing trendy investments, that's your warning sign. But right now they're still focused on the fundamentals. Burry owns Berkshire because it's basically a portfolio of survival stocks in one ticker. All right, 3 down. Now let's get to stock number 4, and this one is genuinely unexpected. All right, stock number 4. And I'll be honest, when I first saw this on Burry's list, I was confused, because this one doesn't fit the pattern at first glance. The 4th stock is Alphabet, Google's parent company. Now you're probably thinking, wait, a tech company? How does a tech company survive crashes? Didn't we just say tech gets destroyed? And you're right to be confused. But here's where Burry sees something different. Let's look at what actually happened. Google went public in 2004, so it wasn't around for the earlier crashes. But let's talk about what we do have data for. During the 2008 financial crisis, when the entire market was collapsing, Google's stock dropped about 50%. Sounds bad, right? But here's the key. Their revenue barely dropped. Their business kept growing. Why? Because even in a recession, businesses still need to advertise. And Google had become the way to advertise. Fast forward to COVID in 2020. Everything shut down. Except, what did people do? They went online. Google search traffic exploded. YouTube usage skyrocketed. Their ad revenue actually increased during a pandemic. So what's Burry seeing here that makes this different from other tech companies? Here's the insight. Google isn't really a tech company anymore. It's an infrastructure company. Let me explain what I mean. When you want to find anything online, you Google it. It's literally become a verb. Businesses don't have a choice. If they want customers, they need to show up on Google. That's not optional. That's essential. YouTube is the same thing. It's not just entertainment. It's where people learn skills, research products, and consume news. During COVID, YouTube became more essential than cable TV. And here's the kicker: Google Cloud. Businesses are moving everything to the cloud. That's not a trend that's reversing. Whether we're in a boom or a recession, companies need cloud infrastructure. But wait, there's more to Burry's thinking. Google prints cash like no other company. We're talking 50 to 60% profit margins on their core business. They have almost zero debt, and they're sitting on over $100 billion in cash. That means when a crash happens, they can actually buy competitors or expand while everyone else is struggling. The recession logic here is genius. During downturns, advertising budgets get cut, but they don't disappear. They just shift to what works. And Google has decades of data proving their ads work. So traditional advertising dies and digital advertising through Google survives. Now, the risk nobody talks about: government regulation. If the U.S. government ever successfully breaks up Google or heavily regulates their advertising business, this thesis falls apart. That's the one thing that could change everything. Burry knows this, which is why his position isn't massive. But for now, Google has become as essential to modern business as electricity or phones. And that's why it's on this list. Okay, let's zoom out. We've covered 4 very different stocks: Johnson & Johnson, Procter & Gamble, Berkshire Hathaway, and Alphabet. Healthcare, consumer goods, diversified businesses, and tech infrastructure. They seem totally unrelated, right? Wrong. There are 3 specific traits that connect all of them. And this is what Burry is actually looking for. Trait number 1: inelastic demand. These companies sell things people need, not want. Healthcare, toothpaste, insurance, and search advertising. Whether the economy is good or bad, demand for these things stays relatively stable. Trait number 2. High barriers to entry. You can't just start a new Johnson & Johnson. You can't launch a competitor to Procter & Gamble and take their shelf space. You can't build a new railroad overnight. And you definitely can't create a new Google. These businesses have moats that took decades to build. Trait number 3. Cash generation. Every single one of these companies prints money. Real cash flow, real profits, not promises or growth potential. Actual money hitting the bank account every quarter. That means during crashes they can survive, buy competitors, and come out stronger. This is the framework Burry uses. And here's why this matters more than the actual stock names. These 4 stocks might not be the best picks 5 years from now. Markets change, industries evolve, but the framework doesn't change. Inelastic demand, high barriers, cash generation, that's timeless. The biggest mistake investors make during crashes, they panic and sell everything, or worse, they chase whatever's going up that day. Burry does the opposite. He looks for companies with these 3 traits and buys them when everyone else is scared. That's how you survive crashes, not by predicting them, but by owning businesses that can weather them. So there you have it, Michael Burry's 4 stocks that survived every major crash. Johnson & Johnson, Procter & Gamble, Berkshire Hathaway, and Alphabet. But here's what I want you to remember. These stocks aren't magic. What matters is the thinking behind them. Inelastic demand, high barriers to entry, real cash flow. That's the filter Burry uses, and that's the filter you can use to protect your own portfolio. Now here's your homework, and I'm serious about this. Pick one of these 4 stocks. Go look at their financial statements. Look at how they performed in 2008, in 2020. See the pattern for yourself. Don't just take my word for it. Don't even take Burry's word for it. Do your own research, because the goal here isn't to copy someone else's portfolio. The goal is to learn how to think like the investors who survive. If you found this valuable, hit that like button right now. It helps this video reach more people who need to hear it. And if you're not subscribed yet, click that subscribe button. We're breaking down real investment strategies every week, no fluff. Drop a comment below and tell me, which of these 4 stocks surprised you the most? I read every single comment. Want to go deeper? I've got another video breaking down how to actually read financial statements during a crash. Link is right here. Thanks for watching Smart Money Insights. I'll see you in the next one.